Welcome, traders, to another Tickmill trading update with me, Patrick Munley. Want to update the SP 500 view using the Emini futures contract and put together a trade plan and some high probability price targets for the trading week ahead. So, before we jump into the charts, let's review where we are on as of the closing last week. S&P 500 up 1.5% for the week, with new all-time highs being reached across multiple sectors. In terms of trend, monthly, weekly, and daily timeframes now are in a one-time framing up mode, suggesting further expansion to the upside. We were looking for about 220 points of range for the S&P 500 throughout July, and that gave us an upside target for the month at 64.40 to 64.65. Overnight, we traded into a high of just shy of the upper bound for that monthly range. So we tagged the 64.57 as our current cycle high, and we are seeing a bit of a pullback develop, but more about that shortly. In terms of the market breadth, note last week we did start to see some divergence in terms of breadth as prices at an index level were making new highs. Some of the single stocks were starting to print lower breadth in terms of those trading above their 20-day moving average. I finished last week at 69 versus 58% the prior week. So we're seeing some more momentum come into the market. Stocks over the 50-day are 73% versus the 65% last week. And stocks over their 200-day moving average finished at 63% versus 58%. So market breadth can be deemed to be back on track after that last week's divergence. In terms of the gamma profile, it's a long gamma environment as we start the week. The gamma flip continues its move higher, implying that calls are still getting rolled up and rolled out to the upside. At a cash level, the S&P 500, 6,400 was a key level last week and something to watch out for this week. Realized volatility is being led by the trailing quarter, and combined with the long gamma environment means that from a market maker perspective, it's a question of buy the dips and sell the rip environment that continues. The past 2 weeks of the net long gamma has scored in the highs for the year. In terms of the calendar for the week ahead, it's really one that obviously overnight was driven by, the market dynamic was driven by the news of a deal between Europe, the EU, and the US. So that sort of gap higher, but we have since reversed that. And again, I'll talk more about that shortly. In terms of data for the week, nothing of note today. Tomorrow, consumer confidence. Wednesday, the FOMC, which is going to be interesting to say the least. And we also get GDP data. On Thursday, we get core PCE and jobless claims. And on Friday, we get non-farm payrolls. In terms of earnings, Wednesday and Thursday are really where the action is going to be, with Microsoft and Meta reporting on Wednesday and Apple and Amazon reporting on Thursday. There will be videos to follow this week, and I'll explain my views on those earnings releases and where there is some potential trading opportunities out of those big constituents of the Mag 7. So moving to the charts, in terms of where we are from a technical perspective, the daily VWAP is bullish. 63.90. We need to trade below there to flip the 5-period volume weighted average price negative. And on the weekly time frame, that's a bit lower at 63.45. And like I say, we're one time framing up, which would end at 64.02 on the daily. So we're currently trading 64.32, just ahead of the New York Open. So a little bit of work to do on the downside there to to negate the near-term trend. Weekly 63.18 and monthly back at 58.70. And so where we are from a technical perspective is that this week we are looking for a potential implied volatility range, which would see potential resistance coming in at 65.15 and to the downside support at the 63.35. Do note that we also have that 127 extension from the post-tariff decline coming in at 64.91. and 65.27. So there's an interesting area up here that I'll be watching very carefully as we head into this week. If we do trade into that zone, I'll be watching for bearish reversal patterns to play some tactical counter trend shorts. Let's move to the actual intraday time frame, and we can start to put together an idea of where the next intraday opportunities are. So as I say, we gapped higher last night. We are now looking at a potential gap fill. So gap fill from overnight would see us needing to test the 64.28. We currently now are just pushing into that area. So potential support to come in there. So if we fill the gap and we get some bullish reversal patterns developing here, this is the hourly time frame. We will be looking for long positions to engage, to take out the price cycle highs and move up to test daily projected range resistance coming in at 64.87. For this week, I'm using the 63.90 to 63.80 as the bull bear zone. So if we don't find support on the gap fill as we head into the cash session, I would anticipate that we could see a squeeze lower to test into that weekly bull bear zone. Also coincides with the hourly trend channel support. And again, I watch for bullish reversal patterns there to engage on the long side with the same initial upside objectives. But ultimately, what I would be looking for this week, if we get continued positive catalyst, is a move up into our 65.15 area. And like I say, from there, I will be watching for bearish reversal patterns as an opportunity to engage on the short side. And initially, we would obviously look for a retest of these prior highs into the 64.57. Now, if we continue to trade lower, there is the potential that we put in a bearish island reversal pattern on the daily time frame. And if we take out the weekly bull bear zone, we're going to use that then as resistance to target a move down into the 63.35 on the downside. And then from there, we'll see again do buyers step in. I would note that from a seasonal perspective, the tailwinds of July are going to meet the potential headwinds in terms of seasonal risk to the S&P. We also have the VIX trading at 15.22, and the end of July tends to be a pretty significant inflection point for the VIX. Certainly, over the last 30 years or so, we tend to see a spike in volatility as we head into August and September. So that's something to keep in mind. But as I say, those are the trading levels that I'm looking at on the weekly time frame. For daily updates, you can follow this my blog here through Tickmill, where I give intraday trading levels and trading strategies with targets and stops in mind. So please feel free to follow along on a daily basis. But like I say, on the weekly time frame, these are the key levels I will be watching as we head into this week. As always, traders, plan the trade the plan, and most importantly, manage your risk. Until next time, thanks very much.